Hard money loans differ from traditional bank financing because they focus on property value rather than the borrower's credit score. Private lenders and investors provide these short-term loans at interest rates between 8% and 15%, typically lasting 6 to 24 months. The lender covers 65% to 75% of the property's value, leaving room for security. Single-family homes dominate the hard money lending space for several compelling reasons. They have a lower entry cost compared to commercial properties and enjoy strong demand across the country. These properties are less risky for lenders because they're highly liquid and easy to resell if borrowers default. Property values are straightforward to assess thanks to abundant comparable sales data. Investors favor single-family homes because they generate steady rental income and appreciate over time. Tenants typically stay longer in houses than apartments, which reduces vacancy periods and turnover costs. Managing one house is simpler than juggling multiple units. When it's time to sell, investors have various exit strategies available. The risks require attention. Local market conditions can shift, so understanding your specific area is critical. Property condition issues can surprise you without thorough inspections. Tenant quality makes or breaks rental success, making screening processes vital. You need to factor in vacancy periods, repair costs, and unexpected maintenance expenses. Financing options beyond hard money include conventional loans with lower rates but stricter requirements, portfolio lenders offering flexibility, private lenders with custom terms, and home equity lines of credit. Each option serves different investor needs and situations. Legal compliance matters significantly. State usury laws limit interest rates. Clear documentation protects both parties. Foreclosure procedures must follow established rules. Title searches, lien checks, and zoning verification prevent costly problems. Working with experienced real estate attorneys familiar with hard money transactions is wise. Finding profitable properties means targeting homes with quick value-add potential in desirable neighborhoods. Focus on properties needing cosmetic updates rather than major structural work. Kitchen updates can return 70–80% of investment, bathroom remodels 60–80%, and curb appeal improvements 75–85%. Energy efficiency upgrades appeal to modern buyers, but return less at 50–70%. Building a network of hard money lenders increases your funding options. Different lenders specialize in various property types and risk levels. Real estate attorneys, brokers, and industry groups provide lender referrals. Attending meetings and joining investor associations expands your connections. Maintaining detailed financial records from past projects strengthens future loan applications and demonstrates your track record. Having relationships with multiple lenders gives you flexibility when traditional financing falls short. You can close deals faster and negotiate better terms when you have options. Market conditions change, so a diverse lending network protects your ability to fund projects consistently.